This is a story from the stock market that showcases an important concept and lesson that many investors, including Warren Buffett, have used to produce stellar results. In late 1963, the value of American Express was almost cut in half, falling from $65 to $37 a share. It was triggered by probably the strangest scandal in stock market history, the Great Salad Oil Mystery. A company called Allied Crude tricked American Express into believing that they had $150 million worth of soybean oil as collateral when they actually had only $6 million. American Express gave credit to Allied Crude based on this collateral. When the scandal was unearthed in mid-November 1963, it caused a turmoil in the stock market and led to bankruptcies. To make things worse, on the following Friday, President Kennedy was assassinated and the stock market crashed. The broader market recovered. However, American Express was not so lucky and was caught in a free fall, falling from $65 a share in November 1963 to $37 a share in January 1964, a 43% decline in less than 90 days. At this point, people were fearful of buying the American Express stock. It was for these situations that Warren Buffett said, "Be fearful when others are greedy, and greedy when others are fearful." With this in mind, Warren Buffett reviewed American Express's business model and concluded that the company's moat, which is its competitive advantage, would not be materially impacted by this event. American Express was a unique growth story, its core business was unharmed, and its brand would survive. So Warren Buffett was greedy when others were fearful. And he was so greedy that he subsequently invested 40% of his partnership's money in the American Express stock. And American Express grew tenfold in the next 10 years. So be greedy when others are fearful. Before we look at the other side of the story, please take a moment to hit the subscribe button if you want to hear more investment tips and advice to help you in your journey. The other side of the story is that you should be fearful when others are greedy. If you invested in the US stock market in late 1999 and early 2000, when everybody was greedy with the dot-com boom, you would have been in for a shock when the market crashed in March 2000 due to the dot-com burst. If you had invested at the wrong time at that point, you could have lost 75% of your money. So be careful in a rising market, especially when the stock market has recorded an all-time high. This is the time when others are greedy and you have to be fearful. Now, this doesn't mean that you should never invest at such points, but it means that investments, as always, have to be driven by the fundamentals of a business and the value of a stock. And if you want to avoid a stock market mistake that cost me millions, watch this video.